Hi everyone, Michael Elliott. I am the Campground CPA with Camp and Park Accounting, coming to you today with question number 6 in our Ask the Campground CPA Questions series, a series where we take some of the most common questions that we receive as the only exclusive CPA dedicated to the campground and RV park industry, questions that I get from campground owners like yourselves about finance, about accounting, about taxes as it relates to you and your campground or RV park. So one of the questions I get pretty commonly is, what is ROI? What is ROI? I hear the term thrown around a lot, but Michael, explain to us what it is. So ROI is return on investment. So it's return on investment. A lot of people throw this term around as a way to try to justify an expenditure that they plan on making. So it's typically a way that we look at the value of an investment that we're going to make. What is that value on investment? What is the return that we're going to make on our investment? So there's a number of different ways to calculate it, but I want to talk today just about, in general, what does that mean? So a good example of trying to understand ROI or return on investment is when we're looking at when we're with a campground or RV park and we're looking at the potential of adding some accommodations, things like cabins, yurts, teepees, things of that nature. So let's take a cabin as an example. So what we're doing when trying to look at return on investment is we're saying, okay, if we go put a $20,000 cabin at our park, how much can we expect to earn on that cabin? So a lot of folks, what they do is they say, well, I'm going to rent it out at $100 a night. I'm going to have 20 nights, so therefore I've got $2,000 of additional revenue. And a lot of folks then want to take that $2,000, we divide it by what we paid for the asset, right? And we can see that 2,000 divided by 20,000 is 10%. So a lot of folks think the return on investment is 10%. That's a little bit deceiving because in addition to having the revenue, you of course know that you're also going to have expenses associated with that. You're going to have cleaning. You're going to have supplies. You're also potentially going to have some expenses you're not going to incur this year, like some deferred maintenance, right? I mean, you're going to replace a railing. You're going to replace a chair every once in a while. So you need to build some of those things in. So what we encourage park owners to do is we encourage park owners to make a fair and reasonable estimate of the amount of revenue that's going to be associated with that asset. So to take a look at what our expected occupancy is. If you've already got other cabins, maybe you know what expected occupancy you can expect, what your rates may look like, and do some math and figure out that in a normal year, here's how much we're going to earn in gross revenue on this asset. And so let's say in our example that we're going to expect to earn $10,000 in additional revenue as a result of putting the new cabin in. So then what we need to do is we then need to look at the costs that are associated with that. And this can be tricky, allocating cleaning costs and things like that. But sit down and do some math. Figure out how often the cabin's going to have to be cleaned, how much you're paying your cleaning staff. Add in things like taxes and workers' compensation. Think about how much it's going to cost you in cleaning supplies. How much do you realistically need to set aside for deferred maintenance? You need to think through that too. Is it $1,000 a year that you think it's going to cost to maintain that cabin? Put an estimate together of what that may be. Total up all of your expenses. Let's say in this situation, let's say it's $5,000 of expenses. Then what we do is we take the $10,000 of revenue that we're anticipating, we subtract the $5,000 of expenditures that we're anticipating having, coming up to a net of $5,000. So then you can do the math from there. You take your $5,000 anticipated net income on that asset, divide it by the cost of the property, and you can see that your return on that investment is 25%, which is a very significant rate of return, far higher than you could earn, say, putting your money in the bank and likely in the stock market, right? A very significant rate of return. Why is rate of return, ROI, why is that important, understanding what that rate of return, the return on that investment is? Well, it's important for a number of different reasons. One is a lot of folks are going to be financing these acquisitions, these investments in these assets. And so we need to make sure that the return on our investment is higher than the return or the rate at which we're paying on that debt, right? The debt service, the interest rate. We need to make sure that it's higher than that, and higher than that significantly enough right, that it justifies the risk of getting that loan in the event that something goes wrong with the asset. It's a significantly high enough rate of return, right, return on that investment, higher than the interest rate that you're paying on that loan to justify taking that risk. It's important to keep in mind with return on investment that it is typically on the front end just an estimate, right? So I recommend being conservative on the revenue estimates and being conservative on the expense estimates, right? Add in a little bit of cushion, sandbag a little bit so that you know going into it kind of what a quote worst case scenario might be in terms of the return on that investment. What you do then is you look at the return on investment, right? You look at your projected rate of return on that asset. And then what you do is you think about what other alternatives do I have instead of this investment, right? Instead of a cabin, right? And what other options do I have, right? Maybe you're comparing. What about a basic cabin versus a deluxe cabin, right? Or what about a yurt as opposed to a cabin? Compare what your estimated return on investment is going to be for that asset over a 1, 3, 5-year period of time so that you're better able to gauge and judge where you should put your dollars, where you should put your risk in terms of borrowing money. Some parks may find that they may be able to drive more net profit by adding amenities beyond simply cabins. For example, adding wibbits for your lake, right? Adding a new playground, things like that that may drive revenue. It might be a little bit harder to calculate for some of those, but may be able to drive revenue in ways that are not just accommodations, registration type of revenue. For some of you, it might be a store remodel, but you can run a return on investment calculation for any of those assets. If we can ever be a help with just talking through investment opportunities, in calculating return on investment, in comparing options, let us know. That's what we do. We're experts in this industry. We understand what your options are, what your costs and your pricing might be, what your anticipated occupancy might be. We can help you analyze those things as you go on. Thanks for joining us today with this question number 6 in the Ask the Campground CPA question series. If you have any questions that you would like answer that are burning, pressing, related to finance, economics on campgrounds, taxes for campgrounds, whatever it may be, if we can answer it, we would love the opportunity to do that. You can submit a question at our website, campandparkaccounting.com, or email it to me directly, michael@campandparkaccounting.com. Thanks so much for joining us today.